Okay, well, as we said, one of the key aspects of transfer pricing is the arm's length principle. The arm's length principle is the well-known and generally accepted international standard that the member states of OECD usually use for analyze the transaction between controlled companies. A transaction is at the arm's length if it has been set at the same condition that would have been set between independent companies in comparable circumstances. And in other words, a transaction is at the arm's length if it has been set at a condition that reflects the market forces. The difference between an arm's length transaction and a controlled transaction is that the transaction between independent companies, as we said, could derive from different and contrasting interests of the companies involved. For example, all the companies want to maximize their profits, and it's probable that all the companies will negotiate the prices. On the other hand, the controlled companies, the companies that are under a common control, doesn't have different interests, but they could agree a fixed price in order to shift profit from a country to another country, in order to maximize the profit of the group considered as a whole entity, for example. So in order to analyze a transaction, in order to determine the arm's length price, we first of all, we need to use a separate accounting approach. This is the approach applied by OECD member states and most of the multinational, for sure. And according to this approach, each entity of the group is to be treated as a single entity. And each profit of a single entity should be taxed by the country of residence. And on the country of residence. In order to analyze the arm's length principle, we need to firstly underline the general definition provided by Article 9 of OECD Model Tax Convention. According to Article 9, we could adjust the IFA group transaction if they are not set at the same condition that we can obtain if we had been analyze a transaction between independent companies, as we said, in a comparable transaction and comparable circumstances. And this comparable transaction is the so-called comparable uncontrolled transaction. To find the comparable transaction in order to compare the transaction between controlled entities and the market forces and the market price, we need to use the so-called comparability analysis. That is another key point of the transfer pricing discipline. First of all, I was forgetting that arm's length principle is the mostly accepted and adopted international standard, and there are some reasons that are enlightened by the OECD guidelines. First of all, arm's length principle works quite effectively in the majority of the cases. For example, especially if the transactions are involved physical commodities and the provision of services that are not highly integrated. On the other hand, there are some issues in the application of arm's length principle, especially if the transaction involved intangibles or intellectual properties. But we have some solutions that are provided by the OECD guidelines or the practice. And but the most important reason, because of the most important reason why the arm's length principle is the international standard, is that it has a large international consensus, and at the moment there is no viable alternative to arm's length principle, for sure. To be honest, the OECD guidelines indicates as a possible alternative the global formulary apportionment. This approach is set on the basis of a mathematical and predetermined formula that would be used to allocate the profits of the transaction between the entities of the group. By the way, this formula would be based on different indicators such as cost, payrolls, assets, function performed, and so on. But it's important to underline that this formula should be predetermined and independent of specific circumstances. By the way, this formula could be a good alternative to arm's length principle in theory, but it has a lot of problems in the concrete application that are individuated by the arm's length, the OECD guidelines. First of all, it's not that easy to find a general and predetermined formula to analyze and that could be fit in all the concrete business realities. And in second place, it's quite difficult to imagine that all the different states could agree in a predetermined formula. For example, each state could emphasize the indicators that could lead to a higher tax base in its country. For example, the most industrialized country could emphasize indicators such as payrolls and assets actually used in the manufacturing, and other countries maybe could emphasize other indicators such as the property of intellectual property and so on. And finally, this approach, this global formulary apportionment doesn't have a large consensus, international consensus, and its application would lead a great and enormous political and administrative cost and complexity. And this is quite difficult to imagine that could happen in the next years, for at least. By the way, sometimes we can see that we can actually see an approach that it's a mixture of global formulary apportionment and the arm's length principle, arm's length standard, because we have some methods and some analysis that use some formulas that are quite near the formula approach, the formulary apportionment, but mere and solely global formulary apportionment is not applied. at least in the international context. So as we said, moving on to the comparability analysis, we said that this analysis is a key point of the arm's length standard and the transfer pricing discipline. We need to use this analysis to find a comparable situation in order to determine if a control transaction is consistent with the arm's length principle or not. In order to find a comparable situation, we need firstly to fully understand the situation of the controlled companies. First of all, we need to analyze the structure of the group and understand how the functions and are allocated and the risks are assumed. In order to do, after doing that, we can find a comparable situation or comparable transaction in order to compare with the controlled ones. As you can see in the slide, the first point is to identify the commercial and financial relations between the companies, the related companies. And after that, we can compare this condition with the one set in the comparable transactions. And the first point we can analyze are the written condition, because this is the easiest part to analyze. For sure, we can see the contractual terms, and after that, we need to be sure that the written conditions are consistent with the actual situation, the actual functions that are performed by the companies. If we notice that the written conditions are not consistent with the actual with the reality of the transaction, we need to use the concrete functions performed and not the written ones. We need in order to analyze the transactions. Here we have an example from the Oecd guidelines of a comparability analysis and how comparability analysis could need to be consistent with the actual reality, the actual function performed by the companies. In extreme summary, this example talk about two different transactions. One transaction that does not represent the reality, because a company could make a great effort in marketing and advertising, and this great effort could influence the prices. And we need to take into account the marketing cost in order to analyze the pricing of the transaction, even if the marketing activity is not provided in the written contract. So once we analyze the transaction, the compared transaction, we need to, first of all, once we analyze the transaction between the control companies, we can find a comparable transaction with independent companies. We have two kinds of comparison: the internal comparison and the external comparison. The first one is when we compare a transaction, a control transaction with a transaction between a member of the group and an independent company. For example, we have a transaction between A and B companies. We compare this one with a transaction between A and a C company, independent one. And we have the second kind of comparison is the external one. In this case, we compare the control transaction with a transaction between independent companies, both independent companies. For example, we have a transaction between A and B, and we compare that with a transaction between C and D, that are independent company that we assume will have set the transaction at the arm's length. After the OECD guidelines has provided some key factor in order to find comparable transaction, the so-called factors of comparabilities. These factors are the same in the OECD guidelines and in the manual issued by United Nations. And the first one is the characteristic of the goods sold and the services provided. This factor is quite important and in a transaction that involved physical goods and the provision of services, normal provision of services. And for example, the characteristics of the goods are quite easy to understand. They are the physical feature, its quality, and so on. And in case of services, they are the nature and the extent of the services. By the way, this factor is it loses some importance if we are analyzing a transaction that involves the intellectual property and intangibles, or services that are highly integrated. This is because in case of intellectual property, the actual characteristic of the good is not that important in order to determine the price, actually, because we cannot have, it's difficult to find an exact comparable transaction involving intellectual properties. The second comparability factor is the functional analysis. This one is maybe the most important part of the comparability analysis. And this analysis focuses on the functions that are performed and the risk allocation between the companies. Of course, the compensation of a company, it's dependent of the function that the company has actually performed. And using this analysis, we can understand how the functions are actually allocated between the groups, and how the function involved could influence the prices, and especially how the risks are assumed among the companies. So the risk analysis is quite difficult part of the comparability analysis. This is because the assumption of risk could be easily bargained by the multinational companies, because they are quite intangibles, quite easy to manipulate. And the reason of that is that from different risks could lead a different level of compensation. It's an economic principle that if a company has an increased risk in the transaction, should be have as well an increased compensation from the transaction too. So in order to compare different transactions, we need to carefully analyze the risk and the function involved, because the different function or different risk allocation could lead to a different transaction that are not actually comparable. The third factor is the contract terms of the transaction. As we said, we need to analyze the contract terms, and if they are consistent with the actual function performed. And the fourth.
Well, Paolo, sorry.
Yeah.
I think that before approach the next points, I think that we can make the second break of this second part now, and then we can maybe make a little recap of the first 2 points, because the slides were very full of concepts, very interesting. Well, I think that could be useful for students to make a little recap of the first 2 points, and then you can go through the next aspects. And thank you, because we did a lot about the OECD model and guidelines, and you approach also that point. So for now, thank you very much.
You're welcome.